You just bought a coffee, $5.23. You tap your card, grab your cup, and walk out. Simple transaction. Done. Except it's not done. Somewhere in the background, a silent machine just activated. Within milliseconds, about 15 cents disappeared from that $5. It didn't go to the coffee shop, it didn't go to the government, it went to a private system that you've probably never thought about. And that 15 cents, it's just the beginning. This happens every single time you use a credit card. Every swipe, every tap, every online checkout, a small percentage of your money gets carved off and sent somewhere else. Most people never notice because it doesn't appear on their receipt. It's hidden. But here's the strange part. That tiny percentage adds up to over $100 billion every year. That's more than the entire GDP of some countries. And it's paid by, well, that's where things get interesting. So who actually pays this invisible fee? How did this system become so massive? And why is there a good chance you're paying more than you realize every single day? Let's start at the beginning. Credit cards didn't always work this way. In fact, the entire system we use today was basically invented in the 1950s, but the economics behind it took decades to evolve into what it is now. To understand the hidden tax, you first need to understand something called interchange. Interchange is the fee that one bank pays another bank whenever you use a credit card. When you swipe your card at a coffee shop, your bank, the one that issued your card, is effectively saying to the coffee shop's bank, "We'll handle the payment, but you owe us a small cut." That small cut is the interchange fee, and it's typically around 1 to 3% of the total transaction. Now, that sounds technical and boring, but here's what actually happens. Let's use that $5 coffee again. You tap your card. The coffee shop's terminal sends a message to its bank asking for authorization. That bank forwards the request to your bank through the card network, Visa, Mastercard, or sometimes American Express or Discover. Your bank checks your balance, approves the charge, and sends approval back. The whole process takes less than a second.
But in that second, your bank takes about 15 cents from the $5. That's the interchange fee. The coffee shop receives $4.85. Here's the question. Why does your bank get to take that money? The official explanation is that the fee covers risk. When you use a credit card, your bank is lending you money temporarily. You're not actually spending your own money at that moment, you're spending the bank's money, and you promise to pay it back at the end of the month. If you don't pay it back, the bank absorbs the loss. The interchange fee is supposed to compensate the bank for that risk. That sounds reasonable until you look at the numbers. The average interchange fee in the United States is about 2.2%. In Europe, it's capped at 0.3%. That's not a typo. European merchants pay less than 1/3 of 1% for the exact same transaction. American merchants pay more than 7 times that amount. So why the difference? Why do Americans pay so much more? The answer comes down to one word: regulation, or rather the lack of it. In 2010, the United States passed something called the Durbin Amendment. This was supposed to cap interchange fees, but there was a massive loophole. The cap only applied to debit cards issued by banks with more than $10 billion in assets. Credit cards were completely exempt, so the fees kept growing. Meanwhile, in Europe and Australia and many other countries, regulators decided that a 2% tax on every transaction wasn't good for the economy. They capped the fees, and merchants passed those savings to consumers. In America, the system remained largely unregulated, and the banks loved it. But here's the real twist. The interchange fee isn't the only cost. When you swipe your card, there are actually 3 separate fees involved. The interchange fee goes to your bank, but there's also something called the assessment fee, which goes to Visa or Mastercard. That's usually around 0.1%. And then there's the processor fee, which goes to the company that actually handles the payment infrastructure. That can be another small percentage. Add all of them together, and the average merchant pays about 2.9% plus 30 cents per transaction. 2.9% doesn't sound like much, but let's put that into perspective.
Imagine you own a small coffee shop. You sell 1,000 cups of coffee a day at $5. That's $5,000 in revenue. But you're paying about 2.9% of that to credit card companies. That's $145 per day. Over a year, that's almost $53,000. For a small business owner, that's huge. That's the difference between hiring an extra employee and not. That's the difference between upgrading equipment and keeping old machines. And here's the thing, most coffee shops don't have a choice. They can't refuse credit cards. Customers expect to pay with cards. If you're a small business and you say cash only, you're going to lose customers. So you accept the fees and you raise your prices to cover them, which means you're paying that fee. Every time you buy something, the merchant has already built the cost of credit card processing into the price. You're paying it, even if you can't see it on your receipt. But here's where the economics become truly fascinating. The interchange fee doesn't just go to the bank. Most of it goes to something else entirely: credit card rewards. That's right, those airline miles, those cashback points, those hotel rewards, they're not free. You're paying for them through this hidden fee. When you earn 2% cashback on your credit card, that 2% is paid for by the interchange fee. The merchant pays 3%, your bank takes 1% as profit and gives you 2% as a reward. Or sometimes the reverse. The bank takes 2% and gives you 1%. The exact split varies, but the economics are always the same. The rewards are funded by the fees. Now, this creates a fascinating inequality. If you have a high-end travel rewards card, you're earning maybe 2 to 3% cash back. If you have a basic card with no rewards, you're earning nothing. But the merchant pays the same fee either way, so who benefits? Well, wealthy people are more likely to have premium rewards cards. Lower income people are more likely to use debit cards or basic credit cards with no rewards. The wealthy get cash back, the lower income don't. But both groups pay the same higher prices because merchants raise prices for everyone to cover the fees. So the system essentially transfers money from people who don't use rewards cards to people who do. It's a regressive tax. It takes a larger percentage of income from lower income people and gives benefits to higher income people. That's not something the banks advertise, but it's exactly how the math works. Now let's look at the bigger picture. Total credit card transaction volume in the United States annually is $6 trillion annually. That's $6 trillion moving through the system every year. At an average fee of 2.2%, that's over $130 billion in interchange fees alone. Add assessment fees and processor fees, and the total is closer to $160 billion per year. That's more than the annual budget of some federal agencies. That's more than the entire market capitalization of many Fortune 500 companies. It's a massive economy hidden inside the simple act of swiping a card. And who gets that money? The biggest winners are the banks that issue cards. JP Morgan Chase, Bank of America, Citigroup, Wells Fargo. These are the largest credit card issuers. Collectively, they collect tens of billions in interchange fees annually. Visa and Mastercard also profit, though their share is smaller. They take the assessment fees and also earn money from processing volume. It's a complex ecosystem, and every player takes a slice. But here's the thing, the system might be changing.
In recent years, there's been growing pressure to cap interchange fees in the United States. Retailers have been lobbying for years. Some large retailers have even tried to negotiate directly with Visa and Mastercard to lower their fees. In 2022, a major court case allowed merchants to challenge the fees more aggressively, and some politicians have started talking about reform. But the banks have an enormous lobbying machine. They've spent hundreds of millions of dollars defending the current system, and they have a powerful argument. Credit cards provide convenience, they enable commerce, they offer fraud protection, and they fund rewards that consumers love. The question is whether consumers would still love those rewards if they understood who was really paying for them. Let's take a step back and ask the big question. What is this system really? It's a private tax. It's a fee imposed on every credit card transaction, paid by merchants, passed to consumers, and collected by a small group of financial institutions. It's one of the largest hidden transfers of wealth in the American economy, and most people don't even know it exists. The system grew organically over 70 years. It started as a simple way to let people buy things without carrying cash. It evolved into a complex financial infrastructure, and along the way, the economic incentives created a machine that extracts billions from every transaction. The genius of the system is its invisibility. You never see the fee, you never have to approve it, it just happens. And because it's distributed across billions of tiny transactions, it never seems large enough to notice. But when you aggregate those tiny amounts, the scale is staggering. So what does the future hold? Some experts believe interchange fees will eventually be capped in the United States, following the European and Australian models. Others think the system will evolve through technology. Cryptocurrency and blockchain payments, if they become mainstream, could bypass the traditional payment networks entirely. Stablecoins and central bank digital currencies could create alternative infrastructure with lower fees. But those are long-term scenarios. For now, the system remains, and it's only getting bigger. E-commerce continues to grow. Contactless payments continue to expand. Every year, more transactions happen through cards, which means more fees flow into the system. And every year, you pay a little more for everything you buy. There's an irony to all of this. When you use a credit card, you think you're using a convenient tool, and you are. But you're also participating in a massive economic machine that quietly shifts money from your pocket to the financial system. The next time you tap your card, think about what's happening behind that tiny LED light. A private tax is being collected, a reward is being funded, a bank is earning a profit, and somewhere a small business owner is calculating whether they can afford to accept your payment. That's the invisible economics of the credit card, and it's been hiding in plain sight the whole time. So, how does this actually work? Well, it works because we let it. We accept the convenience and ignore the cost. We love the rewards and forget who pays for them. We swipe, tap, and move on. And that's exactly how the system was designed. What about other invisible costs hiding in everyday life? If you thought the 3% tax on everything you buy was surprising, wait until you see how the shipping industry secretly charges you for packages you never even ordered. That's the economics of the supply chain nobody talks about, and it might be even bigger. If this completely changed the way you think about every credit card purchase you make, consider subscribing to Mr. Capital. We uncover the hidden economics behind the things you use every day, and trust me, the next one might surprise you even more.